Hi everybody, this is Phil Holoka from Complete Captive Management Services. Today we continue our three-part series on the Bordereau Report. Today's conversation is, what will it tell you once you get your hands on it? So to recap from last week, the duty of the Bordereau Report is to provide the group captive information about the premiums that have been collected by the fronting carrier. And in this example, the carrier is withholding the premiums. Therefore, this is a funds withheld arrangement. So insured number 1, insured number 2, 3, 4, and there could be hundreds of insureds here. The Bordereau Report silos each insured into its own column month by month. So in other words, for January, insured number 1 paid $22,000 worth of premium. Insured number 2 paid $18,000 worth of premium. And when you add up all the rows for January, the fronting carrier has collected $80,000 worth of premium. Now, captives offload a certain amount of the catastrophic risk. The excess coverage is coverage that protects the captive on the very big claims. Usually, the attachment of excess policies ranges from $250,000 to $400,000, $500,000, $600,000, $600,000. The excess carrier will charge a premium for this. And oh, by the way, the excess carrier is usually the fronting carrier also. So the fronting carrier pulls double duty when it fronts a group captive. So let's assume for a minute that insured number 1 has a $50,000 retention and the excess coverage attaches at $250,000. Therefore, the working layer is $200,000, 50 up through 250. The premium to take a big claim off the table is $6,000. That leaves $16,000 to fund the working layer of the captive. And when you total those working layer funds, in this example, it's $57,000. That's called ceded premium. Now, these two rows are what we call an administrative fee. This is the fronting fee. Let's call this a 10% cost. This 10% comes off of this number, usually. And as you can see in this example, these 4 insureds are paying $5,700 to the insured, or the fronting carrier, for its services. Now, this is usually adjusted based on a quota share arrangement. Well, now wait a minute. What is quota share? Well, in this example, 100% quota share means the fronting carrier is not taking any risk. Therefore, the 10% fronting fee is arguably the replacement of the lost underwriting profits for the carrier. If this were 90 or 80-20 quota share, this number will adjust. So if this were 80%, that means a claim of $100,000 hits the working layer, the captive will pay $80,000 and the carrier will pay $20,000. For that service, many times there might be another premium listed down here. But since this is 100% quota share, we don't have any other premiums. In addition, state premium tax. Because the fronting carrier is an admitted carrier, it must pay state premium tax in the state in which the policy is issued. Therefore, 2, 3, whatever percentage comes off of that number. And in this example, $1,600 is paid to premium tax. So the ceded premium is $57,000, administrative cost is $7,000. That leaves $50,000 for working capital. Now, the Bordereau Report will also report claims. In this example, let's say insured number 2 has a $25,000 claim, and insured number 3 has $50,000. Well, there's $75,000 worth of claims. Uh-oh, but there's only $50,000 available. What happens to this deficit? Well, good thing we're going to talk about it next week. But in summary, when you start with $80,000 of premium and you go down to $50,000 as a working capital layer, the delta between 50 and 80 is what's called the expense load. That is vital to every employer and consultant out there to understand the expense load. Now, on a quarterly basis, the carrier will remit the Bordereau Report to the group captive, and the group captive will report the following on its financial statements. It's going to report a due from $50,000, premium revenue of $80,000. Now wait a minute, this $80,000 is taxed by the domicile. Will you be taxed up here also? Well, yes. Group captives pay state premium tax and domicile tax. And then ceded premium expense, $29,000. That's the expense load. That's what you need to understand. And next week, we're going to compare and contrast how to better understand the value. So until then, see you next week.